Gold has been on a tear this year, hitting new all-time highs month after month and signaling the start of a bull market. Investors are tracking price charts, consulting advisors, and asking the big question: how high can gold go? With this surge, many new investors are joining in, putting their trust in one of the oldest forms of money. But just as important as knowing when to buy in is knowing when the current cycle is nearing its peak. In today's video, we'll explore 3 key factors driving gold's rise and what to look for when the market starts to cool off. For more in-depth insights and compelling stories in the world of precious metals, don't forget to subscribe and stay updated with our latest videos. Your support helps us continue bringing you valuable content. Gold has been trading comfortably above $2,600 per ounce, but just a year ago it was less than $1,900 an ounce. A 40% rise in 1 year is nothing to sneeze at, and early investors of gold are congratulating themselves on decisions wisely made. But eventually the momentum will wane, as it does for all investments. There are 3 drivers of the current gold rally that are continuing to sustain today. And there is a 4th one, a wild card, that is always present and can appear at any given moment to send gold either soaring or crashing. The first and one of the most significant forces driving gold to new all-time highs is the unprecedented buying by central banks around the world. According to data from the World Gold Council, central banks have been net purchasers of gold for over a decade, with recent years breaking eyebrow-raising records. In 2022, central banks bought over 1,000 metric tons of gold, the highest level in over 50 years. In 2023, central banks put on a repeat performance and bought another 1,037 tons of gold. Central banks around the world now own over 17% of the entire supply of gold ever mined. One of the main reasons that central banks hold gold is as a risk-off asset, and the exact amount they hold is usually managed by a formula that takes into account total foreign exchange reserves. But just like wealthy individual investors, central banks will accumulate more gold during periods of economic and geopolitical uncertainty. One of the most interesting theories surrounding central bank gold buying in recent years relates to inflation. As inflation rises and erodes the purchasing power of fiat currencies, gold becomes even more attractive. Central banks may increase their gold holdings as part of a broader strategy to preserve the value of their reserves. Since gold historically holds its value even when inflation runs high, it serves as a crucial asset to protect against the devaluation of fiat currencies in their foreign reserves. And that brings us to the second major driver of the current gold market: inflation and a devaluing dollar. These two forces are closely intertwined. As inflation rises, the purchasing power of the US dollar declines, meaning that the same amount of money buys fewer goods and services over time. Between 2020 and 2024, inflation in the US surged by over 21%, with 2022 alone seeing an increase of 9.1%, the highest inflation rate in over 40 years. Historically, gold has been seen as a hedge against inflation, and during periods of rising prices, investors often turn to gold to preserve their wealth. This dynamic is playing out today as inflation's bite has sunk in over the last 4 years, pushing more people to buy gold as a safe store of value. In 1990, the average new car cost $15,000, which you could buy with about 39 troy ounces of gold. In 2023, the average new car costs just a hair over $47,000, which you could purchase with approximately 24 ounces of gold. This shows how gold has not only preserved wealth against inflation as a phenomenal store of value, but also actually increased in value over time when you consider purchasing power. Longtime investors and gold bugs know this and have many anecdotes and examples to prove the point over decades. When inflation appears, gold demand rises in response. And that brings us to the final driver: interest rates set by the Federal Reserve. Longtime viewers of our channel will know we watch the Fed funds rate closely, as well as other monetary policies set by the US Central Bank. It's a well-known and often repeated fact that low interest rates are good for gold, but it's the combination of high inflation and low rates that make a particularly appealing case for gold investing. An investor intends to make money on their assets when they invest it. But if you make less money on your investments than the current inflation rate, you are in effect losing money. As an example, let's say you buy treasuries that earn 2% interest, but inflation is 3%. You've now lost 1% on the deal. If you assume that gold will simply hold its value, meaning no loss and no gain, then gold is suddenly very appealing to a modern investor. This is why when Christopher Waller, one of the Federal Reserve Board of Governors, made positive remarks last December in a press conference regarding rate cuts, gold shot to new all-time highs. With inflation still on the warpath and rates beginning their descent, forward-looking markets on betting on gold rising yet again. All three of these elements have met in a confluence of good fortune for gold investors, but this also means if any of these three elements begin to slow down, gold may as well. Gold bugs should keep their eyes on central bank gold buying and watch for a pivot in their policies. If they stop buying, it could drain the momentum from the current bull market. And similarly, the Federal Reserve will eventually cease cutting rates, which have been moments that markets could rally behind and look forward to. How far and how fast the Fed decides to cut is unknown. And lastly, inflation is ever present. A deflationary environment seems unlikely, given Washington's proclivities towards limitless spending. But if inflation ever ceases or reverses, it may be a bellwether for the end of the current bull run. While investors should watch these three elements to know when to consider shifting their own gold accumulation strategies, there is always an unknown element. We are referring to black swan events. A black swan is a rare and unpredictable event characterized by dire consequences, and yet, in retrospect, it appears as if we should have known all along. Black swan events were first coined by Nassim Taleb, a Wall Street trader and mathematician who argued that rare events have sample sizes far too small to be statistically predictable. The 2008 financial crisis had so many warning signs, and yet few traders realized what was happening until it was too late. The events of 9/11, the COVID-19 pandemic, and the collapse of Silicon Valley Bank are all examples of black swan events. Some of these events have varied and widespread effects across society, economic markets, and of course, gold. The most recent example, the collapse of Silicon Valley Bank in March 2023, resulted in one of the largest flights to gold ever experienced. For nearly 2 months, record gold buying ensued as investors feared contagion through the banking system and a repeat of 2008. While there are other factors that can influence gold prices, the ones we've covered in this video are key signals to watch as potential turning points in the current bull run. Stay informed, keep an eye on the trends, and be prepared to adjust your strategy as the market evolves. That's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.